Here's the thing. When we're talking about risk management, really what we're talking about is losses, right? We're talking about where could the company be at risk of losing money or losing resources or losing market share. Where is the company in danger of losses? Losses are either incurred through assets that the company owns or through the activities that the company does, right? So if you think about it, what is primarily at risk for an organization? Well, what's at risk is the assets that they have and the activities that they do may cause a loss. So it's really one of those two things. So your risk is through your assets or it's through your activities. A loss exposure is any condition that presents the possibility of a loss, regardless of whether or not that loss actually happens. Let's take the example of an accounting firm, okay? The accounting firm has a possibility of a loss simply by preparing tax returns, right? So, the fact is that if an accountant is preparing a tax return and that firm cranks out a return and there's something wrong with that return, well, there's a loss that could be associated with it. Now, is it possible that that a company could go through its accounting life and not actually ever have a loss because of cranking out a bad tax return? Well, of course it is. So the loss exposure is there. However, even if we don't actually have a loss itself to talk about, so even if the company never gets a client coming back and suing that accounting firm, never has a claim against its professional liability insurance, even if that never happens, the fact is that there's still an exposure by just the company engaging in the activity of preparing tax returns or doing audits or just doing the normal things that it does within the market.